Hi, welcome back. And hopefully this is the last part of chapter 13. And I don't want to go for too long. The overstatement of asset fraud is the first section of this part. And as I showed you in the list of companies, the top 25, it appeared in over a dozen instances. And if we expand that 25 to include smaller losses below 100 million, we can see that there's a great list of companies where overstatement of asset frauds were found out. And again, you have the usual suspects: Waste Management, Enron, Adelphia Communications, Quest Communications, the big players where billions of dollars were lost because of the overstatements of assets. And you can see the different categories of the overstatement of assets associated with improper acquisitions, associated with improper trading, associated with repo transactions, associated with improper revenue recognition. Remember, revenue is one side. Usually you have some asset on the other side that you are debiting when you're crediting the income, whether it's cash received in a bank, whether it's a debit to the accounts receivable, and so forth. All right. So there's always two sides to a fraud. Often a revenue fraud is committed alongside an overstatement of asset fraud, and so forth. Think about, in that top 25, what were the two combinations of frauds committed in that table earlier in this chapter. How the fraud was executed. Again, I want you to have a look at one or two of these cases to really understand how they went about the fraud. And the symptom, in the end, whistleblowers helped out. In the end, external investigations helped to uncover these overstatement of asset frauds. To help you understand the data in the previous table a little bit better, I have graphed how the fraud was executed, and most commonly, improperly treated expenses as assets. So for example, if you have expenses related to an acquisition, then instead of writing off as an expense, you may move it to a goodwill account. You may write it off to a deferred expense account. You actually capitalize that expense rather than write off the expense on acquisition. All right. Inflated asset values, it's likely to happen on acquisitions as well. Falsified bank records, overstated earnings. Again, remember, like I said in the previous chapter, overstated earnings is related to the overstatement of asset frauds. Get the connection between the two. And there we have improperly recognized upfront revenue and hid debt in the off-books entities. We know Enron, the WellCom, and some of those big usual suspects did things of that nature. I've already given an example of that, where you do the top line revenue fraud. You create a fake sale, you create a fake receivable. Overstatement of fixed assets, overstatement of assets through mergers and acquisitions, overstatement of intangible or deferred assets. Much harder to uncover. They're intangible. There may not be something that you see. There may not be pure documentation other than the purchase transaction involved. What is the actual value of that asset if it's intangible? That is a subjective judgment. And so a lot of fraudsters go down this tunnel. So next is the improper capitalization of costs as assets. That should be expensed in the current period. This is a normal go-to fraud, because if you can move an expense into an asset, then that moves it off your profit and loss statement. It makes your profit higher, and it moves the expense onto your balance sheet. And later on, you can write that off. You can write that expense off as inventory shrinkage, as a bad debt. Wow. Right? But ultimately, it's an improper capitalization, and things should be expensed in the period. The accounting standards are pretty clear about when an expense is an expense and when an expense should be capitalized. All right, it's that period accounting treatment. The slippery slope of earnings management. Again, chapter 12 and chapter 13. If you didn't know it by now, we are in the earnings management realm where the C managers, the executives, are manipulating the financial statements on behalf of the organization against the shareholders, against the creditors, against other stakeholders. A good example is WorldCom. The SEC accused WorldCom of inflating its reported income by a staggering $9 billion. They achieved this by manipulating their accounting practices. Instead of properly recording certain expenses as costs that should be reflected in their current earnings, like line costs, computer costs, WorldCom's senior management instructed their accounting teams to classify these expenses as assets. This misrepresentation artificially reduced their operating expenses, causing them to appear more profitable than they were. This is a classic earnings management tool where assets are just being overstated, expenses are being understated in order to manipulate that earnings per share measure that analysts are looking for. As is said here, the company was facing increased pressure to meet earnings targets. If they failed, then their share price would have went down. That's all linked to bonuses and other compensation that senior management were tied into. Another way of inflating assets is through mergers and acquisitions. This is a pure play on that uncertainty, that information asymmetry about the true value of the newly formed company. And a lot of companies manipulate and inflate assets as a result of the merger and acquisition transaction. Maybe no value was created, but then goodwill and acquisition is created and it becomes an asset in the balance sheet. The examples of schemes include inappropriately recording market values for assets, having the wrong entity act as the purchaser of the other entity, or improperly allocating book values to assets. Overstatement of fixed assets, property, plant, and equipment. Again, the big one here is underreporting depreciation expense or overstating residual values. When you underreport depreciation expenses or overstate residual values, the depreciation expense that goes into the profit and loss makes the net profit higher. Beautiful. Your earnings per share looks great. That is the most common manipulated value out of every one of these areas. Cash and short-term investment fraud. You may think, oh, you can't touch cash and short-term investment. Why? Because the auditor, or let alone the fraud investigator, can go and double check. They can check with a third party how much cash you have. They can check with a third-party financial institution where you have the investments and verify those investments. But don't speak too soon, because the Parmalat fraud is an example. The example of Parmalat shows that overstating cash is not impossible. In this case, the company fraudulently generated fake audit confirmations from banks to create the illusion of holding billions of dollars in cash that didn't exist. And if it wasn't just Parmalat, what about Satyam Computer Services? Another case. The Indian company was found to have fabricated cash balances exceeding $1 billion. Adelphia, they hid over $2.3 billion in bank debt by transferring it to unconsolidated affiliates. Lehman Brothers, they manipulated their financial statements through Repo 105 and 108 transactions. You better watch the movie, The Big Short. It was all about what Lehman Brothers did. Amazing. So these are all cases that highlight that cash and short-term investment fraud are go-to areas if senior management believe that they can be manipulated. Wow. Overstatement of accounts receivable, not related to revenue recognition or inventory. Remember, overstatement of accounts receivable. In chapter 12, we talked about how companies can inflate the value of accounts receivable by recording fake revenues. I talked about that. All right. However, sometimes companies might overstate accounts receivable or inventory, not to inflate income, but to make their assets look better and conceal thefts of cash. Ah, wow. To actually, you press up accounts receivable and reduce the bank cash balance and you steal the cash. The case of ESM, the management had stolen $350 million and covered this theft by creating a fake receivable from a related company. Similarly, the Farmore case, one reason for overstating inventory was to balance out the cash that Mickey Monis had taken from the business to fund his now unsuccessful World Baseball League. So these are exceptions to that easy money of inflating sales and accounts receivable. Here, accounts receivable against the bank, accounts receivable against another account in the financial statements. So here are several instances of how to overstate assets and the accounts involved and the fraud schemes. Do have a look at these, because you can see that, for one, if we want to improperly capitalize costs that should be expensed, then we can inappropriately capitalize as assets various kinds of startup costs, marketing costs, salaries, research and development costs, and other expenditures. Most common as well. These costs should all be written off as expenses at the time of acquisition, but you capitalize it and call it deferred acquisition costs, call it deferred goodwill, you call it an asset in the balance sheet. And you can see that some of these assets can be overstated and manipulated by undertaking these types of fraud schemes. If we look at overstating fixed assets or misstating cash and marketable securities or accounts receivable, then we can go and undertake these types of fraud schemes. Moving on to the symptoms of the overstatement of asset frauds, the most common fraud symptoms was discrepancies in reported cash balances, unexplained tracing of revenue growth, discrepancies in reported versus actual earnings inventory, and unexplained revenue growth versus the competitors. You can see there are many other symptoms that were raised, but these were the most frequent. If we look at the largest overstatement of asset frauds, how the fraud was uncovered, it was uncovered via an external audit and SEC investigation, an external audit and SEC Department of Justice investigation, or an external audit prompted by whistleblowers, board member whistleblowers, bankruptcy examiner's report. As you can see, these were external investigations and external whistleblowing activities that uncovered the frauds. It's amazing that many of these asset frauds were not uncovered internally. Let's have a look at the last part, and this is something that affects every financial statement, because the profit and loss, the balance sheet and cash flow statements are not enough without the footnotes, without the disclosures to explain various revenues, various expenses, and various assets and liabilities in the financial statements. Financial statements, they do consist of these various line items. And as I said, the disclosures in the footnotes and other documents are needed to explain what these line items mean. Inadequate disclosure fraud involves the issuance of fraudulent and misleading statements in the disclosures. That is, somewhere in this annual report or through press releases or other media, management makes statements that are wrong or do not impact the numbers or line items on the financial statements. Disclosure fraud can also include statements that should have been but were not made by management, misleading because of what is not said, or fraud by omission. So they should have said something, but they left it out. And this makes disclosure fraud very hard to detect because it's very hard to see something that has been left out. If we look at the largest inadequate disclosure frauds that I have listed here, again, the usual suspects: Enron, Adelphia Communications, WorldCom, inadequate disclosures, how the fraud was executed, the symptom, and the whistleblower, how uncovered. A lot of these frauds, again, were uncovered by external parties, external investigations associated with whistleblower complaint concerns. Kinds of disclosure fraud. They can be categorized in terms of three groups: misrepresentations about the nature of the company, misrepresentations or omissions in the MD&A or in other non-financial statement sections of annual reports, and misrepresentations or omissions in the footnotes. An example is Adelphia Communications Corporation was involved in numerous transactions that were not properly disclosed. These transactions were with board members, executives, and entities controlled by Adelphia. The SEC alleged that Adelphia did not reveal these transactions or misrepresented their details in its financial reports. Over $300 million of the company's funds were secretly diverted to senior management without proper disclosure to investors. And so this was a disclosure that was improperly made, and SEC held Adelphia to account. Unfortunately, the investors did lose as a result of the combined fraud with other balance sheet items committed by Adelphia. Detecting inadequate disclosure fraud, as I said, it is hard to look for something that has not been disclosed. But the symptoms to look for are different depending on the kind of disclosure fraud you are concerned about. With overall misrepresentation or its products, it is necessary to look for symptoms related to the company, its assets and organization, its management and operating characteristics. So you need to have an in-depth knowledge of the industry the company is working in. With disclosure fraud relating to non-financial statement part of annual reports or in the footnotes, you look for different kinds of symptoms. Taking a broad view, the kind of symptoms you look for to find frauds are similar to the symptoms you search for when looking for investment scams or Ponzi schemes. In some ways, investment scams or Ponzi schemes are asset inflation frauds, where you are inflating investments over time to get people to give you more money. The inflation of your investment shows you are a good investment manager, and it enables you to promote and get more people into your Ponzi scheme. You also need to look out for companies that have unrealistically large growth in assets, revenues, or profits, a short history, involve unknown management, other characteristics that make their performance or representations look suspicious. Again, this is something where you just need that industry knowledge so you can be more sensitive to what to look for in the company you are investigating. Several fraud examination techniques can be used to detect inadequate disclosures. You can look for inconsistencies between disclosures and information in the financial statements and other information available. You can make inquiries of management and other personnel concerning related party transactions, contingent liabilities, contractual obligations. And you can review the company's files and records with the SEC and other regulatory agencies concerning the names of officers and directors who occupy management or directorship positions in other companies. Other types of financial statement fraud are numerous to mention, but we just list them here near the end of the chapter: inappropriate accounting for non-monetary transactions, round-trip transactions, improper accounting for foreign payments in violation of the Foreign Corrupt Practices Act. We're in the realm of international accounting here. Improper use of non-GAAP financial measures, improper use of off-balance sheet arrangements, and Enron is the usual suspect here. Finally, I just want to close on chapter 13 and show you that, yes, these are the big guys or girls, but when we look for frauds below 100 million, below 50 million, below 10 million, there are hundreds of them. Too many to list here. The big takeaway is that none of these fraud types are singular in the big frauds undertaken. 2/3 of these frauds were a combined of two or more of these fraud types, as you can see. It wasn't till we go to fraud number 17 and below where I could only pick out one type of fraud being undertaken. But often revenue is combined with a balance sheet item. Inventory is combined with revenue or a disclosure item. And notice disclosure is not necessarily associated with 17 to 18. Why is that the case? These are things that can help reveal to you the importance of what we're talking about in chapter 12 and chapter 13, rather than approaching your learning by just trying to memorize all the different types of frauds that exist. Look at the cases, enjoy the cases of how the fraud was executed, how was the fraud found out, and finally, how was it prosecuted. This is O'Connor finishing up the final part of chapter 13. See you in the class. Bye for now.